What's up you guys, it's Paul here. In my previous few videos, I showed you exactly how I used an option strategy called Strangle to 3, 4 or 5x my money after the company announced earnings, okay? But at the same time, in this video, I actually want to show you examples of stocks where the trade did not go my way and I either broke even or lost some money, okay? Now, the reason I want to share that with you guys is so that you can learn not only how you can 3 or 4x your money, but also how you can manage your risk and limit your losses when the trade does not go your way, okay? Now, the first lesson that I learned was that you should always choose options that are expiring at least 2 to 3 weeks after earnings, okay? And the reason I give at least 2 to 3 weeks is because weekly options tend to be cheap and they move a lot, but they also decay very quickly, okay? Now, since they decay very quickly, if the stock doesn't move a whole lot like you would expect it to, then you could potentially lose money on the options because of the theta decay, and you end up, even if the trade does go your way, you can lose you can lose money on it, okay? And not only is theta decay going to work against you, but if the trade doesn't go your way, you won't actually have enough time to be able to convert the option into a spread and at least lock in some profits, okay? Because if all the options lose value, even if you convert it into a spread, the amount you get back is going to be very minimal, and that won't be enough for you to be able to break even on your money or limit your losses, okay? Let me show you an example here. I'm looking at Disney options here expiring on August 14th. So let's say I take this 132 call as an example here. It's valued at $112 per call option. And if you look at the theta value here, it's minus 0.13, which means that this option is going to decay at $13 per day, assuming all other factors and the value of the stock stays the same, okay? So let's say 2 days down the line, Disney is still trading at exactly $130. The value of this option would drop from $112 to around $86, okay? And that's called the theta decay, where if you give it only 1 week, then even if the stock doesn't actually move a whole lot, then you're still losing value on the options, okay? But let's say you look at an option, say 2 more weeks out on August 28th, that same call is way more expensive, $275, but the theta is only $8.06, okay? So that same thing, instead of dropping by $26 after 2 days, for example, this would drop only about $17, okay? And also, but the fact that you now have about 3 weeks instead of just 1 week, depending on how much Disney moves on the upside or downside, you're actually giving yourself enough time to convert it into some kind of a spread and at least break even or make a small profit without losing money on it, okay? The second lesson that I learned is to have patience. The reason you want patience, similar to choosing options that expire 2 to 3 weeks, is that there's always a bit of a continuation after earnings, either on the upside or downside, okay? The reason for this is because once earnings actually come out and investors have a better understanding of how the company is performing, they're either more optimistic and pile in money into the cash that'll raise the stock price, or they're pessimistic and they start selling out and the stock can keep going down, okay? So several times, if you miss the earnings play, you can actually potentially ride these continuations and make an additional profit, okay? So let's see some examples. So I'm looking at Disney here again. Let's say if I go a week before Disney announced earnings, I believe it was after hours on August 4th or maybe pre-market on August 5th, I don't exactly remember, but right after earnings came out, the stock shot up quite a bit, and even though it shot up a lot, I actually sold out right around here. But if you see my previous video, the value of my option shot up from around $83 all the way to $685, which is a huge profit. But if you follow the stock here, and if I was just more patient, it actually kept going up even more, okay? And if I waited a few more days, it started going up as high as $131, where at this point in time, just before the option was about to expire, instead of selling it at $685, I could have actually sold it for $900, okay? The call that I had was $122 strike, which is why 131.46 minus 122 is all about 950. So instead of getting 685 per call, I could have potentially got 950 per call, and I would have turned $573 into $2,800 instead of just 1975. Okay. Now that's one of those cases where I missed out on an additional $900. Now, even though that's not exactly a loss, $900 is still a lot. Okay, so instead of 3 calls, if I had 30 calls, that 900 extra could have been worth $9,000. Okay, so this is where patience can make a big difference on the profit side. Now, if I look at it from losses, for example, if I look at Fastly here. So on Fastly 2, I had a Strangle where I bought a $140 call and an $84 put that was about to expire on August 14th. Okay. Now, right after Fastly announced earnings, it plunged quite a bit, and it dropped all the way from around $107 or $109 all the way to $88, which is quite a bit, actually. But the problem was, because I already bought an option that was far out of the money, which was $84, it did go up in value, but it did not go up too much. Why? First reason, my option was expiring on August 14th, which was just a week out instead of the 2 to 3 weeks that I told you. So there was too much theta decay on it, and so it decayed a lot. Okay. Now, another issue was, because I sold out right here, I almost just broke even, or in fact, the calls were very expensive leading up to earnings. So I lost way more money on the call side than the little profit that I made on the put side, and ended up actually losing around $200. But if I were just a little more patient and waited till August 14th, which is still a whole week, Fastly still kept going down and down and down. And right around here, if you look at the August 14th puts, the 84 put is worth $750. Now, instead of selling out at just $400, I could have sold it for $750. And in fact, I remember intraday, this was actually worth almost $900 at some point when Fastly came down as low as $76 or $77. Okay, so that's where, if I were a little more patient, instead of losing $200, I could have potentially made another a $200 to $300 profit instead of losing money. Okay, same thing with Virgin Galactic. Right after earnings, it dropped a lot, and I saw that it was going up a little, and I sold out here too quickly, and I lost about $130 on it, if you saw my previous video. But that was because I thought the put is not going to go up any further, and I decided, okay, let me just sell out and at least limit my losses here. But if only I was a little more patient. As you can see here, Virgin Galactic kept going down, and by August 7th, when the option was about to expire, this actually went down all as low as $18.20. So instead of selling my 7 puts for around $100, I could have potentially sold it for almost $560. Okay, so again, same thing. Instead of losing $130, I could have potentially made about $300 profit. Okay, that's why having patience is extremely important. Now, another example was, if you missed the earnings play, I mentioned here that you could potentially ride these continuations and make an additional profit. Okay, so the example for that is actually with Pinterest here, where they announced earnings here and it spiked up a lot, and right after it spiked, I pretty much sold out here, and even though I almost 5 or 6x my money, and I was pretty happy with that. Say you did miss out on this, you could potentially buy some calls around here, because there's still so much continuation after that. Okay, so let's say you bought some $34 or $35 call here. It still went up as high as almost $37 here. And even here, August 7th, it crossed $37. So you could have still made a couple $100 profit just by writing the continuation. Okay, so you don't always need to get this huge jump from earnings. You could still understand how a particular stock can behave after earnings and make some profits out of the continuation. Okay, that's how Pinterest did. If you look at Disney, same thing with Disney. It shot up, came down a little bit. If you bought some calls around here or around here, there's still a little bit of continuation, but the stock kept going up, and you could have potentially made a decent bit of profit. Maybe not 500-600%, but at least a good 60 to 80% or even 100%, depending on how much the stock moves up, okay? And that's how you can take advantage of continuations. Now, another final lesson that I want you to learn is to avoid earnings if the calls or puts are not similarly priced. The reason I say this is because now if a stock is, if say there's a lot of expectations from a particular company earnings, the call side tend to be more expensive because the stock potentially ran up a lot, leading to earnings, and then the calls tend to be far more expensive than the puts, and then the drop in implied volatility right after earnings can crush that option value, okay? So even if that particular stock goes your way and the stock does shoot up, there's so much movement priced into that call option that theta decay and the drop in implied volatility can crush the value of that option even if the stock moves a lot, and you will still lose money on it, okay? Same thing on the put side. If the stock has been going down leading up to earnings because investors are pessimistic, and even if the stock does drop a lot, the value of the puts can still break even or lose value even after the big drop, because a lot of it is already priced in, okay? So in these situations, when you see that the calls and puts are not similarly priced, I either want you to avoid using the strangle strategy that I'm talking about, or you just ride the run up and sell out to lock in profits before earnings comes out, okay? To see a quick example, this happened to me on Uber, where Uber announced earnings. I think it was after hours on the 6th, I believe, and I had the $31 put and a $35 call option, which was my strangle strategy for this, okay? So if you look at the history of this 35 call, I got it around $83 per call option, and I got 3 of them for $249, okay? Now, before earnings even came out, as you can see, there was a lot of optimism priced into the stock, and it actually went up as high as $170 to $178, okay? Which means before earnings even came out, this call option more than doubled up, okay? In a time like that, where this call option was worth $178 and the put option was only worth $50, okay? And so I should have realized that there's too much optimism already priced into this, and that the call option already went up 100%. And in a situation like that, I could have easily sold out for 100% return, but I got too greedy thinking that this stock might shoot up a lot more after earnings, and that I would, instead of just 100%, I would have made a 400 or 500% profit, okay? So in a situation like that, you could ride up this upside leading up to earnings, lock in your profits and sell out before earnings even come out, and that way you avoid this volatility right after earnings, okay? So as you can see, instead of being up 100% after earnings came out, this dropped heavily in value, and what I did instead was actually sold a 34 call and turned it into a credit spread, okay? Technically it wasn't a credit because I put in $249 for the 35 call, and I got $204 for the credit. So technically it's a debit spread, but I did end up limiting my losses on the one side, but I could have potentially made a lot more profit if I just sold out before earnings came out, okay? Same thing on the put side. I had the $31 puts. I sold them at $180. Yeah, in reality, I put in more like $213 and sold it for $180. And on the call side, I lost $45. So the lesson I actually want you to learn from that is several times when there's that the options are not priced in equally, I want you to just ride up either the call or the put side and sell out before earnings even comes out. And that way you're not risking any more after the earnings play, okay? So that's all I wanted to share with you guys for today. I hope you learned something. Please leave a comment below if any of it was confusing, or if you want me to talk about any other strategies that you have in mind. And be sure to subscribe if you haven't already, and hit the notification bell so that you get notified of my future uploads, okay? So thanks again for watching, and until next time.